And something you alluded to, and I know that you've kind of tweeted about many times, is there's um, in the token market, there's just a lot of I think like kind of empirical evidence of almost market manipulation happening, and you saw this with a lot of the movement. Um, a lot of the movement labs scandal, and there's a number of other tokens that you look at that the whole market goes down and they go up on a certain day, or the token came out and now it's valued at many billions of dollars and has done nothing but go up despite having no real revenue or product live yet. And I guess I just want to ask about this broader trend where it's kind of peaked already at this point, but April and May, there was just a lot of interest in outing some of these scammier tokens and talking about the underbelly of what goes on with market makers. And I like, just in my reporting role, I was really astonished learning about all the deals that go on behind the scenes. Like uh, tokens are lucrative, I guess. And so the innovation flows where the money is. And so people are coming up with lots and lots of ways to kind of grease lots of collective palms in the process of launching a token. And sometimes the token is the whole product. The product is not the product. So looking at that general narrative, do you think that like there's going to be any change? Like has there been any benefit to where investable tokens are going to win and scams are not? Or is this just going to be a continuous problem for crypto based on how the incentives work in this industry?
So I think it's going to be a problem. Will continue to be a problem until assuming we're in a cycle, and at the end of the cycle is the next 12 to 18 months, it's going to continue to be a problem. And the reason is there are a bunch of these types of entities, companies, protocols that have been funded already, and they have cap tables, constructed of the people who tend to do the playbook that you're referring to, which is, hey, launch something at a really low float and a high FDV. And then, hey, I'm going to go OTC and sell my stake at a quote unquote big discount. But, that 50, 60% haircut is like just absolute found money because, as you said, a lot of these things are trading at really high, likely manipulated levels. And the reason they're trading there is because, to your earlier point and assertion, there's incentives in place often with market makers where they have like options on tokens or sort of side deals. That means that they're actually not incentivized to do their core job, which is making both sides of a market, but maybe incentivized to go long and prop up the price so they can sell into it with options they have. And then again, like I said, there's scenarios where the team and or investors have the ability to do OTC deals at quote unquote discounts, but the discounts are to these overinflated, really high valuations. By the way, the exchanges have an incentive to, have really significant trading volume and high valuations as well. I mean, they take percentage-based fees typically on total volume. So, the higher the price and the overall market cap or FDV of these assets, the more fees they're making. Given the same number of tokens changing hands. So, basically everybody who's early in the system and sort of high in this pyramid of token launches does have an incentive to have really high prices, high trading volumes. It's cynical and it leads to misallocation of capital because it's a playbook that has worked for these insiders for 3 to 4 years. And where the capital misallocation comes is one on the retail side because they're getting hyped and marketed these like really high valued, super hot things that really aren't that valuable, and they're trading them for a while and probably losing a little bit, maybe making a little bit here and there. Again, while insiders are making a lot of money on the spread from the private price to the public price. But there's also misallocation of capital to venture funds and to projects, venture funds that support these types of projects versus venture funds that are really focused on investing in things that will have long-term value and long-term revenue creation. So unfortunately, I do think based on what's been funded, since 2022, we're going to see a bunch of junk come to the market in the next 12 months. And, I'll be out there on Twitter telling you to the best of my ability what some of that junk is. And that overhang just has to go through. But I do think the markets are changing now, the early stage private markets, where you're seeing fewer of those junk deals getting funded. And so look out 2 to 4 years, and hopefully, I'm optimistic we'll have healthier, tokens in market. And I think the last point is, it's not just the venture market that impacts venture-backed projects that impact what goes out. Like Hyperliquid took no venture money, and so as you see more successful models without venture money, broader launches, including the actual users in airdrops, and then incentivizing them through productive uses of the token, buybacks, fee discounts, things like that. We're going to get a healthier ecosystem. It just takes time.
It feels like there's just low-hanging fruit you could do to make the token, like liquid token market, not such a total mess. One other, things like disclosing your market makers, and like there's stuff like that you could do. The other thing I used to think about is, it felt to me like in 2023, 2024, one of the big issues with crypto VC was it was very hard to actually book like gains on your investment outside of a token launch, and this led to a lot of projects, in my view, launching tokens that didn't need tokens, and that ends up being bad for like the retail investors that are kind of buying these things often. And so if there was a more active M&A and IPO market, maybe there's other ways for institutional or private investors to realize gains. And so you don't need to not everything needs to have a token that pumps a bunch, which maybe that was naive of me to say, because a more permissive M&A market might mean a more permissive view towards just other things, that crypto companies could do. And if the token makes money, they'll still launch it. But I don't know. Do you think that was short-sighted, or does that play a piece into it too? Is that if we see more IPOs, if we see more mergers and acquisitions, will some of the scams become less, prevalent?
Yeah. So you're always going to have scams in crypto. These are permissionless networks, or many of them are. We won't get into the L2 debate and levels of decentralization, but there's almost no question that having buyers of crypto equity is a net benefit. To your point, it stops the adverse selection of tokens just being issued because there's just no other way to realize value. And so the biggest reason a lot of this has been happening and equity not being valued is there were so many headwinds to equity only regulated crypto businesses under the last U.S. administration, under the UK laws that still exist. But some of these laws, so the U.S. is now passing, we're on the cusp of passing the Genius Act, like a stablecoin bill. They're working on a market structure bill. Hopefully that'll pass later this year. But bottom line is, as those things pass, you'll see, a surge of, call it, institutions and established businesses, enter the market, and not all of them have the capabilities internally built. So many of them will buy, and what often happens has happened in mobile, with Google and Facebook doing tons of acquisitions early on. The best companies are sort of the early, warning signal that this market is hot and heating up. So you've seen Stripe obviously acquire Bridge, now acquire Privy. You've seen Robinhood acquire 2 exchanges, Bitstamp plus a Canadian one. So you're seeing the absolute best fintechs in the world start to seriously expand, into blockchains and permissionless networks. Robinhood mainly still on the trading side, but I think you're going to start to see them working on tokenized assets and the actual form factor of what people are buying as well. And then Stripe, has moved from just building, better networks and money movements to purchasing Privy and looking at financial accounts now, and getting beyond just the pure movement of the money. So it's exciting. Those are a harbinger, I think, of much more M&A to come. And what that means is equity is valuable again. And so that's great because not everybody can invest in tokens, wants to invest in tokens. And when you have equity, the people who are the natural buyers have a, sort of a preference for revenue generating and profit generating companies. Of course, they're valuing real things. So that's great. And you've seen the public market activity recently, Circle going public. It is trading, it feels like, at a mimetic valuation to some extent, but it does show that there's a significant appetite in the public markets for exposure to really big crypto themes like stablecoins. And then beyond that, you have also all these treasury vehicles. What I think is going to happen there is that you can only have so many Me Too copycats treasury vehicles, Bitcoin, Ethereum ones, and Solana ones. I do think you're going to see those companies start to use their treasuries as well for M&A, so they become more productive companies. So it's not going to be sufficient to just be a Solana treasury company and hold the asset. I'm going to have to use the asset, stake it, maybe purchase and run a validator, and then down the road, maybe even start to participate fundamentally in the app layer on top of the blockchains.
Yeah, I do. I do think that the best versions of these treasury companies will do that. To your point, where like Sol Strategies is maybe the first Solana one, and they say that we're like a Bitcoin miner. Like treat us like a Bitcoin mining stock, which
Yep.
if you squint a little bit, but I do think that they like genuinely are making real validator acquisitions, active in the validator space, which also means the governance space in Solana. But that's I don't want to get too much
and
into
then
that
the other
stuff.
one that you see and is like World Liberty Financial, where basically it sort of started out looking a little bit like a treasury company, just buying assets up. But now, with the issuance of their own stablecoin USD1, you can sort of start to see them, branching out into real productive, useful products for end consumers versus just holding assets.